Good afternoon. Welcome back to this episode, and this episode is titled Go. The train is about to leave the station. I know given the volatility in Go, you may be wondering why does it sound quite bullish, but I'll try and explain and give you evidence of my arguments in the slides ahead. I just want to say that currently, or rather the date today is March 16, 2020. Time is about 1:40 Singapore time, and Go currently is trading at about 1540. We're living in a strange world where I have to actually tell you what day it is and where Go is currently at, because the volatility is just so high. So if you see this video on a different date, you may be wondering when was this video done and at what price was Go at that point. So just to state the fact up front. Let's go on to the presentation. Go really has slumped last week, and basically let me just call up the pointer first. It was down about 7% last week in terms of spot Go, and it was down about 33%, whopping 33% for what we call the Hui index, or the index of gold mining companies. In this presentation, I'll talk both, or when I refer to Go, sometimes I'll refer to the spot and sometimes I'll refer to the Hui index. And I'll give you a reconciliation at the end with regards to how these two actually move in tandem, but in different degrees. But so basically they both are representation of movement in Go. Currently, you can assume that. Okay, so basically the decline last week was very bad. It's probably even the worst week in 30 years. So that really has a lot of people asking the question: has Go lost its safe haven status? Just 2 weeks ago, early in March, Goldman was saying that Go has immunity to the coronavirus. And to be fair, not only Goldman but many other people saw Go as the place to go to in order to avoid the volatility that we were seeing in equity markets. So Go bears were kind of shocked, shell-shocked in fact, when the Hui index and also the Go spot prices started to decline last week in tandem with the S&P 500. So many people were scratching their heads as to what was happening. It soon became apparent that actually the primary reason for Go's slump was basically margin calls started to come in for other assets, whether it was for equities or other assets, and Go was liquidated in order to provide liquidity to pay for the margin calls in those various other positions. So that was one key reason, and this is nothing new, and I'll show you later with regards to how it happened during the global financial crisis. Another thing was Go formed a part of many portfolios, and the reason is because Go was treated as a hedge, and as we all know, hedges are meant to offset losses. So those portfolios which had Go within the portfolios were holding up quite well despite the volatility in the equity markets. And investors who saw that basically asked themselves, do I write this down, or do I keep holding my portfolio, or do I just sell my portfolio now while it's still in positive, or maybe even in a small loss, go to cash, go to US Treasuries and wait out this volatility before coming back. So there was a lot of selling of the portfolio in totality. Whole portfolios were unwound and sold, which means that Go, despite being up and despite providing the hedge, was also sold at the same time. It's basically saying that the baby was thrown out of the window with the bathwater at the same time. But that is Go's role as a hedge. So basically that happens in crisis time. Okay, so these were the two reasons why basically Go fell so sharply: margin calls and basically liquidation completely and totally of one's portfolio. Go was the preferred hedge after Q4 2018. If you look at the chart on the right, you'll see the huge decline, and as markets rebounded sharply, very sharply in 2019, everybody started to put Go in their portfolios because after seeing what happened in 2018 Q4, everybody realized that they had to have some level of insurance in their portfolio. So people like Ray Dalio, even in Double Line CEO, Gunlach, these are some of the biggest hedge funds in the world. They were all proposing to put some gold, not everything, but some gold into the portfolio as a form of a hedge, 5 to 10% and so on. So basically that's what happened, and that's why in the previous slide I said the unwinding of these hedges, the selling of gold to make up for the losses on the other parts of one's holdings, all these actually has resulted in a sharp decline in gold. What has made the volatility in gold even more, of course, is ETFs. ETFs has made it easy for individuals to invest in gold. Some ETFs are synthetic, some ETFs are gold back. So the gold back ETFs, if you have bought a gold back ETF, then the ETF would then set aside the physical gold for you, or for the ETF itself, and vice versa. When you sell that gold back ETF, then that ETF would sell physical gold in the market in tandem. So we saw a lot of volatility because there has been a huge increase in ETF participation on the upside, i.e. going long on ETFs, going into the coronavirus situation. So a lot of people took it as a way to hedge and a way to speculate. So that's unwinding also. So that's a secondary reason why gold has become so volatile. The margin calls that we are seeing, they are similar to what we saw in the global financial crisis, but there's a slight difference in terms of magnitude, and let me try and explain. In the global financial crisis, the S&P actually fell gradually from the peak, and it started to move down all the way, as this chart shows you. Gold, represented by the Hui index, actually went up first, which is actually what it's supposed to do, because as we enter into a crisis, people get frightened and they start adding on gold, and gold actually goes up. But as the margin calls creeped in, then gold started to go down. As I mentioned, people would sell gold in order to cover the margin calls. But the main thing to understand why is it different this time around compared to the global financial crisis is because of the magnitude of decline. Way back in the global financial crisis, it took about 41 weeks for the markets to decline by 20%. In the dot-com crisis, it took about 28 weeks for the markets to decline 20%. So far, in this particular decline, it just took 4 weeks for the market to decline 20%. And why is that important? Because margin calls are triggered when levels are hit on the downside. And because the decline was so fast, means that an array of margin calls were made across different stocks and maybe even different assets. So it all came at one time, versus maybe in a more gradual manner when it came to the dot-com bubble, and when it came especially to the global financial crisis, because the decline in the stock market was more orderly in a way in those two instances, versus today where it was actually more abrupt and more volatile. So it was a situation whereby a lot of margin calls came at one time. Gold was sold off aggressively because of that. So the bad news, if you ask me, is that short-term visibility is a little bit unclear. I spoke about the ETFs. This is a chart showing the inflows into ETFs. We saw a lot of inflows last year. Again, people were using it as to hedge against potential decline in markets, and in January and February also an increase because people were worried about the coronavirus and stuff. So basically, you would argue, or one could argue, that you need to clear off all these longs before you see a bottom in gold. Just an example of clearing off the longs. In Q4 2018, people started to put on the ETFs as a hedge, because markets were really very volatile and coming off, and basically they unhedged it, and in the following months after Q4, that means in 2019. So, and because of that, you can see that this is gold price. So gold price actually started to consolidate during the unhedging part, and then started to move higher after that. So potentially, as the market unhedges the ETF position, you could see gold price also consolidate in the weeks and even potentially even the months ahead. But this isn't the main problem to me. In my view, the bigger issue is actually the calling of margins, because we have less visibility there. It's very hard to track in terms of the margin calls. Not all of them are very transparent. You have margin calls across the board, over the counter, in non-traditional assets. We have this headline about South Korean exotic notes facing margin call risk. So an investor in South Korea may be selling gold to meet these margin calls, but no one really has good idea of how much of these notes were issued. Oil price also has gone down so much that a lot of the assets, a lot of the products related to oil price or related to oil may have their own margin calls. We have even a headline on the crypto, where cryptos loans were issued based on cryptos as collateral. Given the fact that Bitcoin has dropped, for example, by 50%, there's a margin call on these collaterals, and these margin calls add up to about 100 million. So what do you do if you have gold and gold still holding up? You sell gold in order to meet these margin calls. And even in a situation, wealth managers, and in this FT article, I believe it's UBS and Credit Suisse, were asking their high net worth clients who typically leverage on a lot of their investments. Given these investments have declined, margin calls have been made. So again, it's actually quite difficult to put a finger on the amount of margin calls that exist in the world today, especially in a highly leveraged world. So this could actually cause short-term volatility in gold, meaning to say we could still see some downside in gold because of continued margin calls. But the good news is basically, after this phase, I believe there's only one clear winner. If you look back at the dot-com bubble, and this chart represents gold, the S&P 500 and the dollar index, you'll find that actually gold goes through three phases, and I kind of alluded to it earlier on. At the start of the crisis, gold goes up because as it's a safe haven, people rush into the safe haven. And then there is a phase two where the margin calls start to come in, the liquidation starts to come in, and gold, as you can see, moves back almost around the same amount that it went up in phase one. But once those margin calls are cleared up, and it's apparent that this bubble now is evolving into a financial crisis or an economic recession, gold then rallies very strongly. And as you can see, phase 3 in this instant, gold went up from 2001 all the way to the peak in 2008 by about 275%. Okay, so this is the three phases for gold. So basically we are now in phase 2, and that's why I'm actually alluding to the big title of this episode, which is the train is about to leave, because we will be entering phase 3. It's a question of just when is this going to happen. Same thing for the global financial crisis. We saw phase 1, which went up about 48, gold went up 48. Phase 2, gold came down 26%, and then phase 3, gold went up about 149%. So short term, the sell-off, I believe, is technical in nature because it's got to do with margin calls and liquidation of total portfolios and stuff. But in the long term, I think the fundamentals driving gold prices higher remains intact. So I think that's a very important point to note. So basically, what gold investors should do is what I call hunker down, which means ride through this volatility. In phase 1 so far, from late December until late February, we've seen gold prices, spot gold go up about 13%. Currently, up to March 13, gold prices have come down. Of course, today it's risen, and I'll talk about it later because of the Fed cut. But until March 13, gold had come down about 7%. So the big question mark is, how much more downside is there to go? We'll try and estimate that, but basically that's just the phase that we have to go through before we see the next phase, which is phase 3, where we've seen before the sharp rallies. And this is where there will be a global economic slowdown. This is where the systemic risk comes in, because especially in this current cycle where there's huge amount of leverage, there's huge amount of debt. When those get unwound, you'll see a lot of systemic risk, and systemic risk refers to the risk of companies going bankrupt and then affecting the rest of the system and so on. And we'll see monetary policy and fiscal policy all move in the direction which is positive to go, and we already seen that with the Federal Reserve on Sunday, and I'll talk about that later, where they cut rates aggressively, and then because gold, and also they did quantitative easing, which is both positive for gold. But even if we go back to business as usual, you'll find that in phase 3, let's say we don't go through a recession, let's say things don't fall apart, and it goes back to business as usual, the experience that we are undergoing today will tell a lot of people that I really need gold to be part of my portfolio. So you'll find a lot of investors will still buy gold and put it into their portfolio because of what they have experienced. So I think net, either way, gold is going to do quite well after this second phase, and as we move into phase 3. I know some of you may be asking, if we see gold coming down over the short term because of more margin calls and things like that, maybe we could actually come out and go back in again. Because here at Financial Alliance, we are longer term investors. We don't try and time the markets. We'll admit to you, we don't know where the markets are going to bottom out. We can make a guess, but we basically don't try. We look at the longer term trends, and if we see that actually gold is going to go higher and we expect to go higher, we don't try and come out first and go back in again. So of course some people may decide to do so, but basically that's not how we approach it from where we stand. But just to give you an answer, where is that question mark, the support potentially, where is that potential support to the downside? As I mentioned earlier, gold sometimes retraces back the first phase. So the second phase potentially takes away whatever we saw in the first phase. This whole upside here was about 13%. Now up to March 13, we're down about 7%. So potentially we could be going down, let's say, based on this assumption, another 6%. So this is just an assumption. We're not trying to pick the bottom, but we're saying this is what happened last time. This could be assumed to happen again, so to say. And that's for spot gold. For the Hui index itself, if you switch over to the technicals, you'll find that the Hui index has what we call a very strong technical support. It's upward sloping trend line, which is found roughly about 135. With the Hui index now about 160 over, that represents a 15% decline and before it reaches what we call a very strong support. So when you look at the spot minus 7%, the technicals minus 15% or even minus 20%, it makes sense because later on we'll discuss about how the Hui index has a leverage effect about 2 to 3 times, sometimes 4 times more than that of the spot price. So whenever the spot goes down by a certain amount, Hui index will actually drop by 3-4 times, and likewise when the spot goes up a certain amount, the Hui index will go up 3-4 times more. Hot off the press. As I woke up this morning, as usual, I opened up the news feed, and it was announced that the Fed has actually cut rates to zero and launched a massive 700 billion quantitative easing program. In my view, given the selling off of gold because of the what we call margin calls, now we have this thing coming in which is really positive for gold, both the cut in interest rates and also the quantitative easing. I won't be surprised if the Fed has just placed a bottom in gold. So things may just be volatile, but instead of one way down, now we have this Federal Reserve action now coming in to offset some of this downside pressure. So we could see a bottoming process, which is very much a consolidation sideways, very choppy, up and down, but not one way down as we saw last week. Federal Reserve effectively cut rates to zero by lowering its target rate to 0.25% from 1 to 1.25%. Okay, and this is on top of what they did most recently, early March, 50%. So this has been extremely aggressive, about 150 basis points within a 2-week period. And and you can see it from this particular chart here. Not sure whether many of you realize, but gold has this intimate relationship, an inverse relationship with what we call real interest rates. One of the main reasons why people are bullish on gold is because they see a decline in what we call real interest rates. And I'll explain in more detail what real interest rates are, but at this point I want to show you two charts. The top chart is taken from a Federal Reserve database called FRED. It is US 20-year TIPS. TIPS stands for Treasury Inflation Protection Securities. It is actually a type of it's a bond, but a bond which actually adjusts itself for inflation. Many economists, many strategists take TIPS as or the differentiation or the percentage in TIPS as what we call a proxy to real interest rates. Okay, so you can consider this as a proxy of what is real interest rates in the US, and I'll explain later. Real interest rates is basically nominal interest rates minus inflation. Okay, and below here is the physical gold price. When you look at it visually now, what you realize that there is a kind of a mirror image, and I've tried to put the two charts in terms of their periods to be almost exact. And you'll see that there's a kind of a mirror image whereby when gold prices, or when the real interest rates come down, gold prices go up, yeah, and vice versa. When real interest rates go up, gold prices come down. Yeah, this basically has a logic behind it, which is if you're talking about real interest rates, which is nominal interest rates and inflation, when nominal interest rates decline, gold becomes more attractive, because gold doesn't produce any dividends and stuff like that. But when there is a comparison between putting money in the bank or some other or assets like a bond, and those interest rates are low, then gold becomes quite attractive because it's low interest rates on the other thing versus something which doesn't give you any interest rate. The second one is basically inflation. As inflation goes up, gold goes up. Yeah, and I'll explain. It's a bit technical, but I'll explain a little bit more later to make it a bit clearer. But for now, let's look at these two charts. So what I'm going to do is I'm going to flip this chart, the TIPS chart, over and superimpose it on the physical gold chart, and let you have a look at how it looks like when it's superimposed on an inverse relationship. So this is how it looks. So basically you have gold prices there, and you have the US real interest rates represented by the TIPS, 20-year TIPS, and it's inversed. Inverse means it's actually reversed. Okay. On March 12, TIPS was 0.14, and March 13, gold was 1562. So basically, when you put these two things together, then roughly you would ask yourself, if the situation going forward is driving real interest rates lower, then what will happen is gold prices will hit higher. Okay, because it's inversely related, the charts are flipped over. So main question is, in order for us to see what will happen to gold in the future, we could actually try and figure out what's going to happen to nominal rates and maybe even inflation. And this relationship is not only for the long term, and as you see, the previous chart was kind of like a 2-3 year chart, but if I just take a 2019 to present itself, which is basically just over about 12-13 months, you'll find that the relationship or the correlation is also quite tight. Yeah, so this is quite a good way to try and figure out where gold prices are going based on the US real interest rates. And this is it, just for you guys who are asking what real interest rates are. The actual formula is this, but what we call the simple formula is this. Real interest rates basically is just nominal interest rates minus of inflation. For example, if your bank gives you 7% inflation, 7% interest rates, to an economist, it's not the real interest rate, because you still have to take into account 2% inflation. So the real rate that you're getting back is only 5%. Okay, so when it comes to gold, remember we said that lower real interest rates is positive for gold. So two things here will help gold prices. One is if nominal interest rates decrease, in this instance from 7 to 5, then real interest rates will go down. And two, even if nominal interest rates stay the same, inflation goes up, then your real interest rate goes down. Okay, so we're looking for two things: lower nominal interest rates and higher inflation. And this has happened. Yesterday, Federal Reserve, as I mentioned earlier, announced this slide was done 2 days ago, and yesterday the Federal Reserve preempted the market. Instead of waiting for March 18 FOMC, yesterday on a Sunday, they actually cut rates based on market expectation. The market had already priced in what we call a 2/3 chance of rates going to 0 to 0.25, which was what the Federal Reserve did, which is basically a 100 basis point cut. So this has actually occurred. So basically now we have nominal rates coming down, which then will drive down real interest rates. And real interest rates basically is something which many people look at. If you're following the gold markets, this is something which people have identified as something driving gold prices. BlackRock, for example, in a most recent comment, spoke about nominal and real interest rates and how gold is well positioned because of falling yields and stuff. Yeah, and it even calculated that real interest rates explain more than 30% change in the price of gold, and so on and so forth. Okay, but as we saw the charts, the correlation is quite tight. What about inflation? Well, we don't have the latest figures for the US and most other countries because the coronavirus has just started in these places. But if you look at China, where the coronavirus has actually ended in a sense, the curve, the impact on inflation was to actually increase food prices and CPI. So these are the CPI numbers for China, which actually went up about 5% because of coronavirus, and COVID-19 has caused even a rise all the way the highest since 2012. So on one sense, in one way, we could say that potentially US inflation could tick up, and when inflation ticks up and when nominal interest rates goes down, you have a double whammy on what we call a collapse or decline in real interest rates, which is going to be positive overall. And the Federal Reserve did announce something quite unexpected in terms of timing. People saw it coming later on, but didn't expect it to be packaged together with the 100 basis point cut. But they packaged a 70 billion quantitative easing with the 100 basis point yesterday. That's a lot, because if you look at the Federal Reserve balance sheet, the Federal Reserve balance sheet currently is just slightly below, I think, 4 trillion, and basically a 700 billion quantitative easing is about 18%. So they're going to increase the Federal Reserve balance sheet by about 18%, which is easily QE4. We had QE1, QE2, QE3, Operation Twist, and so on, and then now I think this is QE4, but it depends. Some people may say QE5 and so on and so forth. Yeah, but it's basically a new QE. I don't know whether some of you realize, but actually the Fed balance sheet, this portion here is with reference to here, it had actually started to creep up late last year. Because there were some issues with the repo markets in the US. The Fed had to inject a lot of liquidity in the repo markets because it was freezing up, became frozen to an extent. That's for a different time to look into. But what I'm trying to also say is that the situation is that more and more liquidity was being pumped in, and now there's a tsunami of liquidity being pumped in. And it's always been good for gold when QE is initiated. I've tried to put two charts together here. The top one represents the various quantitative easing and the timing of the quantitative easing that was taken. And the bottom one represents the Federal Reserve expanding its balance sheet. This is portrayed in terms of what we call monthly changes. Monthly changes means that every month this is the amount that's being added on to the Federal Reserve balance sheet. Okay, so basically what we can infer from here is that in this particular period, you can see that the monthly additions are all positive, which means that the Federal Reserve is injecting liquidity into the system and expanding its balance sheet. And when that happens, you can easily see what happened to gold. So gold rose up very sharply in this period of QE1 and QE2 when there was really very aggressive expansion of the Federal Reserve's balance sheet, i.e. quantitative easing. Gold then actually started to taper off and reach a peak when the market kind of noticed that the Federal Reserve's quantitative easing or the Federal Reserve's balance sheet seems to have stopped and even declined or contracted a bit over this period of time. So the market was a bit like, what's going on? Maybe the Federal Reserve has this intention to stop quantitative easing. Then QE3 came into the picture around here. Okay, and then the Federal Reserve expanded its balance sheet again, but market found it very difficult to pick up. This could be because having reached that point, when the market looks forward, the market saw that there's very little chance of another QE4, QE5. Everybody's long on gold and so on and so forth. So everything added to what we call a very lethargic gold market. And by that time, even though there was a QE3, markets or the gold prices didn't pick up. And eventually, as the Federal Reserve tapered off its QE program, gold started to come off. Okay, this is important because we are now basically potentially at the start of a new QE. So if you were to ask me, I think we are more or less in this particular stage, and that's why the title of today's topic is also, the train is about to leave. And if we really are going into a very bad economic recession and you expect another QE4, QE5 and so on, then gold will benefit. Okay, let's talk a little bit about physicals versus miners before we end. This is a chart showing I put together a Y1 and Y2 axis. So Y1 axis is the Hui index in blue, represented by this side, and Y2 axis is the spot gold, represented on this side. As you can see, they move together, which makes sense because one is the actual goods itself, which is gold, and another is the miners who actually mine the goods or the commodity, which is gold. So they tend to move, not always together, but in general they tend to move together, except that always remember there's this leverage effect. So if you look at the prices itself, you'll find that, for example, over this period in 2018 all the way to 2020, physical gold went up about 43% and the Hui index went up about 82%, about doubling of the Hui index. Most of the time it's double, triple, sometimes you could even see 4 times leverage or 4 times impact. On the way down, recently, physical gold only fell about 7%, but the Hui index fell about 33%. So this leverage effect itself is very important for investors who now say, for example, they want to take advantage of the view that gold is going to go higher. How do I play it? If I play it via the physical, then of course my upside is limited by the move in price. There's no leverage effect. If I want leverage effect, I go into miners, but it works both ways. If it comes down a lot. Okay, so basically I would advise you to seek the advice of a professional consultant or financial planner before investing. In summary, short term, we could see more downside on gold due to the liquidation I mentioned and margin calls. This slide was done before the Federal Reserve announced yesterday its actions. Right now, what it has done is, I would basically say maybe now we could see a little bit more even volatility, because not only to the downside, but now we have people coming in because of what the Federal Reserve do. So maybe the Federal Reserve may have actually set a bottom, but there's going to be still quite a volatile period over the short term as market works all the excesses away and all the margin calls away. However, very, very clear quantitative easing, the sharp cut in the federal funds, which has resulted in a collapse in the real interest rates, all of this inclusive of potential inflationary pressure, all of this is basically the fundamentals which I think will drive gold prices higher. Already gold is up about 2% today because of the Fed cuts. So this is really what I think is the main thing, rather than the short-term volatility that we see because of margin calls and stuff. on the way down, you don't want to be in minus, because minus will actually have that leverage compounding effect of losing much more than actual physical gold. On the way up, you would want to be in minus, in my view, because minus gives you that leverage effect, so you make 4 times more than what the physical gold would make. But I have to warn you, it is really very volatile. For example, the last week. So you really have to understand your risk tolerance. Speak to your advisor to understand, and whether you can take such volatility. If not, just stick to physical gold if you believe that gold has the potential which I've just mentioned. Okay, we come to the end of this presentation. It's a bit long, but an interesting topic. I hope you've benefited from it. And there are many other such episodes on our Financial Alliance YouTube channel. So please do subscribe to the channel in order to be updated with future episodes as and when we post it. So thank you very much for joining me, and I hope to see you again. Thank you.